Most traders don't fail because they're lazy. They fail because they rush. If you've ever opened a chart and felt your heart speed up, if you've ever entered a trade late, watching price move without you, if you've ever chased a candle hoping it would keep going just a little longer, you're not alone. This is where many traders recognize themselves. One loss turns into two. Two trades turn into 10. A plan disappears, replaced by urgency. The screen becomes louder. The clock feels faster. Overtrading doesn't start as a mistake. It starts as frustration. Revenge trading doesn't feel reckless in the moment. It feels justified, like you're taking back what was taken from you. And scalping attracts traders right at this point because it promises speed, and speed feels like control. Fast results, quick opportunities, immediate feedback. But speed doesn't just multiply profits, it multiplies mistakes. Every hesitation becomes expensive. Every emotional click leaves a mark, and the market responds instantly. This is the pain point nobody warns you about. Scalping doesn't give you time to calm down. It doesn't give you space to think things through. It exposes whatever habits you bring with you. That's why so many traders feel exhausted, confused, and discouraged. They think something is wrong with them. They think they lack talent. They think they just haven't found the right indicator yet. The frustration is real, and it's normal. Now, let's slow this down, because to understand scalping, you have to strip away the myths. Scalping is a trading style built on very short time frames, often 1 minute, 3 minutes, or 5 minutes. Trades can last seconds to a few minutes, rarely longer. The goal is simple in theory. Take small, frequent gains while controlling risk tightly. No massive targets, no waiting for huge moves, just consistency. This is where scalping stands apart. Day trading looks for larger intraday moves and fewer trades. Swing trading holds positions for days or even weeks, letting the market unfold over time. Scalping lives at the edge of momentum. It focuses on immediate reactions, liquidity, and structure. And here's the misunderstanding that causes the most damage. Scalping is not gambling. It is not random entries, and it is not constant clicking. Professional scalpers do not trade every minute. They wait more than they act. They select specific moments when conditions align. Every trade has a defined risk. Every exit is planned. Losses are expected, controlled, and accepted quickly. This is where beginners get it wrong. They choose scalping because they want fast money, but scalping actually demands slow discipline inside fast markets. And later, I'll explain why most beginners choose scalping for the wrong reason. Scalping looks fast from the outside, but that's not where the real work happens. Because scalping is less about speed and more about patience. Here's how it actually works. Price doesn't move randomly. It reacts to pressure. It responds to areas where many orders sit waiting. This is market structure. At any moment, price is either pushing forward, pulling back, or pausing. Those pauses matter. They reveal balance. They reveal interest. They reveal where decisions are being made. Scalpers don't chase movement. They wait for price to come to them. Liquidity zones are key. These are areas where buying and selling activity tends to concentrate. Highs, lows, ranges where price has reacted before. When price approaches these zones, something changes. Volume increases. Reactions become sharper. Opportunities form quickly. Entries in scalping are not guesses, they are responses. Price reaches a level, it reacts, the scalper executes with precision. Exits are decided before the trade begins. Targets are small, stops are tight. There's no room for hesitation. This is why precision matters more than prediction. You don't need to know where price will be in an hour. You only need to manage the next few seconds or minutes correctly. Small price movements are enough. A few points, a short push, a quick reaction. Tight stop losses protect capital. They keep mistakes small. They make discipline possible. Quick decisions don't mean rushed decisions. They mean prepared decisions. This is the difference. Now look at the tools. Most people think better tools create better results. They add indicator after indicator, lines, signals, alerts everywhere. But scalping rewards simplicity. Time frames matter. 1 minute, 3 minute, 5 minute, nothing more. Higher time frames provide context. Lower time frames provide execution. That's it. Fewer indicators work better because they reduce hesitation. They keep focus where it belongs, on price. Clean charts encourage clear thinking. Cluttered charts create doubt. If your chart looks crowded, your thinking probably is too. Execution discipline is the final piece. Same setup, same rules, same response every time. More tools do not equal better performance. More rules do. And this is where most traders struggle. They search for complexity instead of consistency. They change setups instead of fixing behavior. They add tools instead of removing emotion. Scalping rewards those who simplify, those who wait, those who act only when conditions align. And that patience is what separates survivors from everyone else.
One mistake. That's all it takes. In scalping, risk is louder than strategy. Because when trades are short and frequent, errors don't fade quietly. They stack, they compound, they escalate. This is why risk matters more in scalping than anywhere else. Scalping wins are small by design. That's the trade-off. You take what the market offers quickly and step away. But small wins demand strict protection. Position sizing becomes the first line of survival. Professional scalpers don't trade big, they trade controlled. Every position is sized so a loss is uncomfortable but never damaging, because survival is the priority. Then comes the stop loss. In scalping, the stop is not optional. It's decided before the entry. It's respected without debate. No moving it, no widening it, no second guessing. Once price crosses that line, the trade is over. No arguments, no excuses. This is the reality many refuse to accept. Risk to reward in scalping looks different. You're not hunting massive multiples, you're stacking consistency. Small gains, high discipline, controlled losses. But here's the truth that hits hardest. One bad session can erase many wins. One emotional hour can undo days of patience. That's why risk management isn't a feature of scalping, it is scalping. And in a moment, I'll explain the mistake that wipes out profitable scalpers. Now let's talk about what actually causes accounts to fail. It's rarely one trade. Overtrading comes first, taking trades without pause, without reset, without selectivity. Trading every movement follows, mistaking activity for opportunity, confusing motion with setup. Ignoring market conditions comes next, forcing trades when the market is slow, forcing trades when spreads widen, forcing trades when clarity disappears. Then emotion takes control. A loss demands a response. A win creates confidence that spills over. Decisions speed up, rules loosen. And finally, no daily limits. No stop after a drawdown, no pause after a streak, just more clicks, more exposure, more damage. Here's the market truth. Most traders lose from frequency, not accuracy. They trade too often, they stay too long, they refuse to step away. Most blown accounts don't come from one trade, they come from many bad decisions. Scalping doesn't reward intensity, it rewards restraint. And the traders who understand that are still standing.
Here's the part most videos avoid. Scalping is not for everyone. And admitting that takes honesty. Because a good trader chooses a style that fits them, not their emotions. Scalping demands a specific type of person, not smarter, not braver, just aligned. It's for traders who can sit still, who can wait without forcing action, who don't need constant excitement to feel progress. It's for those who respect routine, same hours, same process, Same rules every session. Time commitment matters. Scalping can't be rushed between distractions. It requires focus, clear attention, presence. Mental discipline is non-negotiable. You must accept small wins without greed, small losses without frustration, and long periods where doing nothing is the correct move. This is where many people walk away, because scalping is not the fastest path to profits for most people. It only looks that way. If you need constant action, if you struggle to stop after a loss, if boredom pushes you to click, scalping will expose that quickly. And that's not failure, that's information. Now let's talk about the real battlefield, scalping psychology. The market doesn't test your strategy first, it tests your reactions. Emotional control isn't optional here, it's survival. Every trade must feel the same, win or lose. No celebration, no regret. Detachment from outcomes is essential, because obsession with the last trade clouds the next decision. Small wins matter, small losses matter, but neither should move you emotionally. Here's the danger most people overlook: boredom. Boredom convinces you to trade when there's no reason. It whispers that activity equals progress. It slowly bends your rules. And this is the one rule that separates consistent scalpers from frustrated ones. You only trade when conditions are present, never to feel engaged. Now the final reality check. Most people quit scalping for one reason. They confuse excitement with effectiveness. Scalping rewards consistency over intensity, process over impulse, long-term thinking in a fast environment. Those who last don't chase adrenaline, they chase execution. Because scalping rewards discipline, not ego. And if this approach speaks to you, if you want trading explained without hype, you already know what to do. Comment "scalp" if you want a full strategy breakdown. Subscribe for deeper, clearer trading insights. And remember this: in trading, speed doesn't create profits. Discipline does.